When people hear India-US trade deal, they assume it means one big agreement that's signed, sealed, and done. This isn't that. What was announced on February 6, 2026, is an interim trade framework. Think of it as a bridge agreement that sets tariff direction, signals political intent, and creates a path toward a broader pact later. So let's read it in two layers. Layer 1, what the framework says out loud. Layer 2, what it's saying quietly. Part 1, what the deal says out loud. The headline number is 18%. The US says it will apply an 18% reciprocal tariff rate on originating Indian goods, tied to executive orders. Further tariff reductions may follow if the interim framework progresses. In simple terms, this creates a more predictable base rate that can still improve for selected products. The second headline is 500 billion. Indian officials are clear that this figure is aspirational, not a binding purchase commitment.
It reflects potential demand growth
In areas like energy, aviation, and ICT, not a fixed shopping list. So the framework is being positioned as lower friction, higher trade, and a runway to something bigger. Notice the careful handling of agriculture. India's messaging emphasizes protections and exclusions, which matters domestically because farm backlash is always politically risky. That's the official layer. Part 2. Reading between the lines. 1. This is a supply chain deal in tariff clothing. This isn't just about duties, it's about where future manufacturing, critical materials, and high-value exports land. Predictable tariffs help companies choose sourcing locations. If India's effective access to the US looks more competitive than alternatives, supply chains start tilting that way. The quiet message: India wants to be the scalable, trusted alternative, and the US wants more aligned sourcing. 2. The 500 billion number is political cover. In the US, it's framed as opening a major market for American producers. In India, it's softened as demand-driven intent, not obligation. Same headline, different domestic packaging. 3. Energy is the hidden volume driver. Beyond geopolitics, this is basic math. India's growth needs more LNG, crude, and petrochemicals. US exporters want long-term demand certainty. Energy is the easiest way to make big trade numbers look achievable. 4. Agriculture is the pressure point. Fast market opening for US farm goods risks backlash from Indian farmers and small producers. That's why India stresses safeguards, while critics warn the imbalance remains dangerous. Between the lines, agriculture is the most sensitive bargaining chip, and it's being held carefully. 5. Standards matter more than tariffs. Tariffs make headlines. Standards decide scale.
If India aligns faster
On standards for sectors like medical devices and ICT, trade accelerates, but domestic compliance pressure rises. The interim framework signals where regulation may bend next, even before final treaty language exists. Part 3. Who wins? Who worries? What to watch? Early winners. Export sectors that can scale quickly when friction drops, such as textiles, leather, chemicals, and labor-intensive manufacturing. Who worries? Farm groups and small manufacturers exposed to rapid import competition. What to watch next? Which products get reductions beyond 18% and when? Binding language on standards, rules of origin, and safeguards. Energy purchase announcements that quietly carry the big numbers. domestic political pushback, and calls for parliamentary scrutiny. Closing. This framework isn't a finish line. It's a signal to companies about supply chains, a signal to voters about economic wins,
and a signal to negotiators
about what's being traded now versus saved for later.